Very welcome to our Impact Challenger Days. Today we have a special on banking, how the banks report in their sustainability reporting. So I'm happy you're all here. I suggest we go to the next slide and I give you an introduction about us. And in the meantime, if you do have any questions, please use the Q&A tool in your Zoom software. It's a very low end, so you can always send us questions and we are happy to answer them. Can we go on the next slide, please? So we will take a closer look at the reporting of the financial sector, and here's our introduction. We've been doing this research since 2020. In total, we have analyzed over 1,300 reports from more than 500 companies around the globe. And what our clients globally and the media always liked was our methodology, because we can prove where our data is coming from. And you will see on the next slide how that methodology looks like. Before that, our sample, we have analyzed a total of 194 companies, all companies from the DAX, MDAX, and SDAX in Germany, and a total of 35 global international companies. Coming to the methodology on the next slide, you will see that we have translated the standards and frameworks into a questionnaire, which covers currently 1,038 questions, more than 5,000 variables. And this methodology adapts to the material topics defined by the corporates in their binding reporting, which is the annual report and the separate sustainability report. And then we have a three-way analysis of the reporting, which means analyst 1 is going through all the questions. The same thing is done by analyst 2. And then if they have a mismatch in the answers, then our audit team comes in and is overruling analyst 1 or analyst 2. We go on the next slide. We will come to the detail of our sector report. Ariane, over to you.
Thank you, Mike. We chose the banking sector for many reasons, and 3 reasons in numbers expressed we have put here on the slide. All those numbers touch the sustainable restructuring of the economy, which requires immense financial resources. So for the Green Deal alone, that's the first number. The European Union plans to mobilize investments totaling €1 trillion in this decade. For the 2 first EU environmental target, climate protection and climate change, around €350 billion per year in additional investments are required, also according to EU Commission. The link is below if you want to look up yourself. The last number stems from the United Nations, and it gives the estimated investment required to achieve the 17 Sustainable Development Goals as part of the 2030 agenda. And this amounts to more than $7 trillion, again, per year until 2030. So very impressive numbers, which show that in this context, capital market players, especially the banks and financial institutions, play a crucial role. To this fact, we have on the next slide the 3 key conditions which the EU Commission imposes on the banks and on other companies too, but we present them here in the context of our banking sample. The first would be targeting steering of financial flows. As I said, that it's a main goal to steer financial flows into sustainable investments to reach our goals for the EU economy. And for banks, for example, this means that loans especially must be channeled into sustainable projects. That could be loans for sustainable production methods or for private customers who invest in energy efficient homes, just to give you an impression what is meant with that. The second big condition is the consideration of sustainability aspects. You might ask yourself, isn't that the same as the first one? It is a little bit, but it goes beyond that, because it's also about protecting the banks themselves against long-term risks, which can arise from climate change, for example. And this could be loan defaults, just to give you an idea. The third one is strengthening the financial system. And this is all about the resilience of the financial system. And to this end, the ECB has published a second climate stress test for banks, in which they found that that banks can expect their credit risks to increase by more than 100% from 2022 to 2030. If they would accelerate the transition, the scenario would be 60%. So also high numbers from more than 100 to 60%, which show that those three core conditions are very crucial for banks too. There's a third reason, which we displayed on the next slide, showing how banks are connected to reporting. And when they report, they are firsthand a company themselves, giving out documented responsibility, but they are also amongst those stakeholders which finance the Green Deal, and they are set to be the enabler of the Green Deal. So two perspectives on non-financial reporting, which is really important for banks and which we want to evaluate during our presentation a little bit more in detail. Next slide only shows you again the two formats which we have considered for our survey. We have a very narrow definition of sustainability reporting, which is connected to a certain reporting period to only give you the most recent data available, and to have something which is documented, cannot be changed afterwards. And therefore, we see that this document is not only a documentation of responsibility, it's also in terms of banks an expression of how well the sector is succeeding and contributing to the sustainable restructuring of the economy. When we talk about banks on the next slide, we talk about a subsample of 10 banks, which we have in our overall sample of 194 companies. And the banks we have considered, you see on the right side, which is Banco Santander, BNP Paribas, Commerzbank, Crédit Agricole, Deutsche Bank, Deutsche Pfandbriefbank, DZ Bank, HSBC Holdings, Intesa Sanpaolo, and UniCredit. Why are those 10 banks so important to take a look at? That's what you see here on display. We have researched in the European Central Bank what they say about classification of financial institutions, and you see how they classify the banks under their supervisory, and you see 4.8 banks are considered to be significant institutions, whereas 95.2% are less significant, and of those 95.2% of the banks, 4.1 banks are considered as high impact, less significant institutions. For our sample, we have covered 100%. Only one bank is not considered here, since this is headquartered in London and is not under the supervision of EZB. But what you can see is the high importance of the institutions we are looking now and their reporting. What did we consider? On the next slide, please. You see all the reports we have considered for those banks. In total, we had a sample of 366 reports. Since we had 194 companies, that's approximately 2 reports per company. Same is true for the banks, 21 reports, which is 2.1 on average. And if you follow the covers we have put on display here, you see that we have some banks only publishing 1 report as Commerzbank, and others who have also 3 reports. So it's a mixed publication habit we can see here. Since the beginning, we evaluate scope of reporting, which we show on the next slide. And on this slide, we focus on the amount of sustainability information in the annual report. This number is really important for us. We track that really closely, and you can see last year we had a median of 41 pages. This year we already had 67 pages. And for the banking sector, you see we already have 143 pages, which is 76 pages more than the overall sample. So a question we are always asked is more better? Is more detail, more quality? And we will find that out when we go to the next slide. Here you see the overall performance of the banking sample, their overall score marked in yellow. They reach 49% of all possible points, which is 4 points above the GEM all sample. And if you look below, you can see that the best in class in our sample reaches 70 points, which is in the second quartile of all possible points, whereas the last in class only reaches 22 points, which is in the last quartile of all possible points. Since average and best and last is only talking about extremes or average out effects, we wanted to show you an empirical distribution of our sample, and that is what you can see on the right side. So you can see that 6 companies in total have what we call a solid reporting. 2 of them called high performers, 4 in the mid-range, but we also have 4 low performers, which leads to the conclusion that our banking sample reveals major differences in quality of sustainability reporting. Next slide, presenting you the top scorer in banking, which is UniCredit. We present you the top scorer because we want to make transparent our best practice examples to learn from. From this bank, we had 2 reports. We had an annual report and a separate report. We had in total 976 PDF pages for the annual report and 303 PDF pages for the separate report, which is very impressive. And if you want to take a look at very good areas, we recommend to take a look at own workforce and also at sustainability focus to see what we measure, how it is done, and how this bank does it. Sustainability focus leads to materiality, and that introduces the next block of details I want to present, which we call defining the reporting curriculum. On this slide, you can see the material topics of our banks. So we have numbered the banks B1 to B10, and in green, you can see what is material for them. Red means this is not material. And you can see that the material topics vary also in composition, but also in numbers, which is displayed in the last line here. The average is 5 topics. And we marked in green those companies who are above average, and in red those who are below average. You see some of the banks only have, or one bank has only 3 topics, whereas we have another bank which leads with 7 material topic areas. For all banks, very necessary or material are climate and governance. For own workforce, we see one bank not indicating materiality, which was kind of surprising for us because this bank has a total number of 6 material topics, which is above average, and they employ over 150,000 people. So maybe there's an explanation, we have not found it. But to show you, if you have such an image of a sector, it is very important if you have no materiality to give at least some explanation if you find such a distribution of material topics within your industry or within your peer group. Sorry.
Ariana, can I just ask you, how does that work together if the companies define climate as a material topic, but not pollution?
Can you start, because I was coughing? I didn't hear the
Sorry.
beginning of your question.
How does that go together? If companies define climate as a material topic, but not pollution, isn't there an interconnection in it?
There is also for climate and biodiversity, which is at least a topic for companies or for banks in our sample. But we have to see that pollution is more likely to be a topic which affects banks more indirect, whereas climate is a topic which affects them both as companies, but also as stakeholders financing the Green Deal. So we have different considerations we have to take into account. But the thing is, as you see from the distribution, especially in the lower part of our table, that there are many things which need an additional explanation. And in order to help stakeholders to understand this, we would either need sector guidelines as they are under development, for example, with the EFRAG or the Global Reporting Initiative, or we have to look in the reports themselves and to see if we have some indication in forms of different information layers, which helps us to understand. And those 4 layers I have put on the next slide. So the first one we call sustainability focus. What is this inside sustainability focus? This is how was the materiality assessment conducted, information about this, and how is materiality connected to business model and strategy. Only if I know about those aspects, I can understand if the reporting has a clear and focused basis that makes it possible to present material sustainability aspects in a targeted and in-depth manner. The second aspect, stakeholder inclusiveness, is very relevant since we took a look at Global Reporting Initiative, but it is obliged with ESRS. You can find this information in ESRS 2 under point 3, double materiality, where it says that the involvement of affected stakeholders is a central component of the ongoing due diligence and the assessment of materiality of sustainability. So you see, very important to give you some explanation why this is important. If you know the needs of your stakeholders as being users of your sustainability information or being affected by your impacts, you can contextualize your information and give a little bit more understanding for those stakeholders who are either those who give you money, invest in you as a company, or who are the ones who make you responsible, such as NGOs, for example, or other players of the civil society. The third level, value chain reporting, is about describing your value chains to see that or to demonstrate to your stakeholders that you took into account your own operations as well as upstream and downstream activities, including all of your products and services, which gives a holistic view on value chains and is also very important to understand the completeness of reporting. Last but not least, due diligence and risk assessment. This is showing your due diligence process and showing that you also consider non-financial or sustainability risks, which have more often a long-term nature than the classical risks, which are considered in risk management. Let's see how our sample is reporting. Next slide. So you see our needle has gone to the right. The banking sample reaches 71% of all possible points, which is 6 points above GEM all. And you can see below that the best in class is able to reach 92% of the points, and the last in class has 37 points, which is not as bad as we see it in other areas where we are very clearly in the last quartile. If you look at the distribution of the sample, you can see this image again by 7 companies being either ultra or high performers, 2 in the mid-range, and we only have 1 low performer in this area. On the next slide, we see stakeholder inclusiveness, and the needle goes a little bit more to the right, 74% of all possible points, which is 14 points above GEM all. And here our best in class reaches 91% of all points, and the last in class closely to the 50%, reaching 43% of all points. And you see a shift more to the upper part of our bar on the right side. So again, 7 companies being very good here, 2 in the mid-range, and 1 is rising. So we have not really a very poor performer in this area. Next aspect would be the value chain reporting. And unfortunately, our needle now goes to the left with only 41% of all possible points, which is below the average. And you can see we have 6 low performers in this area. And the last in class score only reaches 21% of all possible points. This area is a clear area for improvement for banks. And if you want to understand what we measured here, it's most likely a description of value chains going from upstream to own operations to downstream activities. Due diligence and risk assessment on the next slide, please. Here we again have a very good result, the best result in this block, which is 81% of all possible points. The best in class is able to reach 100%, which is amazing. The last in class, 48%. It's close to 50% of all possible points. And you can see the same on the right side. 9 companies are either ultra high or high performers. That's a very good score here. And the banks do a really good job in their reporting in this area. To summarize it, because I started with saying that those 4 layers are very important to understand the completeness. You can see that there are some areas which are strong, some areas which need a little bit more improvement, especially value chain reporting. So we have some aspects that help us to understand the focus and completeness of these topics, but we also miss some more details. And we will be able to see what changes with ESRS within the next year by tracing our sample in the next year. Next topic now, which is our spotlight for the banks, Spotlight Climate. And we chose this because banks both face direct and indirect challenges from climate change. And I brought you a quote, which I think is kind of nice. It's from Claudia Buch. She is chair of the ECB's supervisory board, and she describes the role of banks compared to that of a bridge by saying that their loans reflect the economic structure of the past, for example, in the form of loans granted to companies with CO2 intensive production. But at the same time, the banks help to shape the future by granting new loans, for example, to produce new renewable energies or anything else in this more future green related economy part. This financing is very important, she also says, because in Europe, we have to reduce our emissions by 2030 by 55%. And we spoke earlier about the investment required to combat climate change alone. And what we have not taken into account yet, but what I want to show on the next slide, are the costs the damage causes. And you can see here the cover of a study by the World Economic Forum, which states that climate change is costing the world $60 million per hour. That's a tremendous high amount of damages. If we go away from the hour level and think about what this will cost by the year 2015, that's estimated in between 1.7 and 3.1 trillion dollars. And what is taken into account here is also important. It's damages to infrastructure, property, agriculture, and human health. So a broad spectrum of effects. Next slide, please. We tried to outline the complexity of risks that can arise for banks in the area of climate with giving you this structure. So let's think about Valencia for a second. We all have the terrible images in our heads. And when we think about this example, we can take into account an individual perspective, which says that for every destroyed property financed with a bank loan that is destroyed by extreme weather events, this not only means a personal loss, but also an increased risk of not being able to service the loan. This example shows that banks have an indirect risk by their loaners being directly impacted by physical risks, for example. We also have, though, a holistic perspective on the topic, because the bank can be challenged as a whole, as well as the entire financial system, because climate risks do not only affect individual borrowers, but they can also have an impact on the bank's entire portfolio. For example, if extreme weather events become more frequent, or if numerous properties, assets, or production sites of companies are collateralized, and this affects the system as a whole. And then banks also have an own perspective on the topics, because they can be directly affected by climate risks if their own buildings or their infrastructure is damaged by extreme weather events. Let's take a look on how important the topic climate is for our banks. Next slide, you can see that 100% of the banks said that climate is a material topic. We also wanted to know, do they state to contribute to the Paris Climate Protection Agreement, which is also 100%. So it is a topic which is in the focus of banks. What they do not do yet is to combine their initiative for the Sustainable Development Goals with materiality, because only 60% of them say that they contribute to SDG 13, which is climate change, and 60% also mention SDG 7, which is all about clean energy. But with 100% indicating material and 100% stating that they pursue their goals in line with the Paris Agreement and contribute to the limiting of global warming, they are pretty good, because in our overall sample, this figure is only 73%. Let's take a look at the quality of climate reporting, which we have on the next slide. So here you can see that our sample reaches 53% of all possible points, which is above GEM ORB, but which is more or less only half of the points which are achievable in this area. The best in class reaches 73 points, the last in class 32 points. We have 4 high performers here, but also 4 low performers. So it's very diverse what we find in climate reporting when we look at the bank sample in our research. To give you another comparison, our insurance sample has reached 51% of all points, so the level is kind of alike. To give you a little bit more context on our data and also what it means for banks, next slide, please. We chose 4 topics which we think is interesting to illustrate the effects. First topic is GHG emissions. Second, resilience. Third, governance on climate. And fourth, the financial effects. I want to dive into those topics one by one, starting with the GHG emissions on the next slide, please. So what we say here is that we have a high overall transparency on scope emissions, which is due to the bar you see on the right side, but the overall performance shows that details are missing in the breakdown of the data. Our sample reaches 45% of all possible points in the area of GHG emissions reporting. And what is very interesting of all the data we are taking a look at in this area is that only one bank categorized their scopes by financial and operational control. This distinction would be important for banks from our point of view because it provides insights into the issues that are directly controlled by the companies, operational, and those that are indirectly influenced by banks, for example, through loans, the financial perspective. If we look at other criteria, the picture is a little bit better. 6 companies already provide a specific breakdown of their emissions according to criteria such as country, segment, economic activity, or emission category. So we have at least some kind of indication of how the emissions are compiled. Let's take a look at the Scope 3 emissions on the next slide. To bring you in the loop, Scope 3 emissions are coming from upstream and downstream activities, or are those which are not considered yet in your own operation activities. And if you want to report on them, ESRS asks you to follow the greenhouse gas protocol, which is since a long time something we call a de facto standard for this area of reporting. In Scope 3, you have 15 different categories, and you are asked to do a material assessment of those categories to decide on which categories you consider when calculating your Scope 3 emissions. And you can see that we have integrated 3 arrows on areas which we think is important. So the first information to understand the data is that only 6 companies have specified their Scope 3 emission categories. And then if you take a look at the breakdown, you can see that from those 6 companies, all of them said business travel is something we take into consideration, which is part of our calculation. If you look at the other categories, we only have numbers in between 1 and 4. So it's a very incoherent picture of how those banks have calculated their Scope 3 emissions. And for example, for employee commuting, it's really surprising because our banks have a high number of employees, and we did a little bit of research. So for the sector, the statistic department says that around 30% do at least sometimes home office, which means 60% are in the offices all the time. So this could have been a number which could have taken into consideration. The other aspect is investments. And here we had internal discussions and went back to the greenhouse gas protocol to understand this area and if we can expect banks to take this into account. And if you look at the greenhouse gas protocol, you can see that those emissions touching investments are associated with operation of investments, including equity and debt investments, as well as project financing. And therefore, this category would be, from our point of view, highly relevant for banks. But we have only 1 bank in our sample who has considered this category while compiling their or calculating their Scope 3 emissions. Next question, next slide, please. It's about resilience reporting. Resilience analysis is part of the transition plan, and our banks do quite well in the area of transition plan. In the area of resilience analysis, we think there is a little bit more room for improvement, although the sector reaches 56% of all possible points. But if you see the number of banks only giving information on their resilience analysis, this is only 5 banks. The good news is, though, when those banks report, they give you even more detail. That's what is on display with the bars being on the level between 4 and 5 banks reporting. So we learn a little bit more about the scope of the resilience analysis, of concrete results, how climate-related risks and opportunity were evaluated in connection with financial performance and position, how strategies impacted were identified, and if it would be necessary to adapt the business strategies. So room for improvement, but different than other sectors. If those banks report, they already give more details. Third topic would be governance on climate. Why did we choose this topic? To give you more insights into climate reporting for banks. That's because an effective governance structure ensures that climate-related risks and opportunities are considered at the highest corporate level and integrated into strategy, planning, and performance evaluation. The average performance score for the bank sector in this area is 45%, which is a little bit above the overall average with 43%. And if we dive into the individual data points, we see in the first block information on processes by which the management board is formed, or how climate-related issues in strategy and planning are considered when reviewing strategy and action plans, and also how climate-related targets are integrated in key performance indicators. 6 of the 10 banks report on this. We have a little less details when it comes to the frequency of the information, how often is the board informed, and when it comes to the methods by which the board is monitoring progress against targets set. Why is this block of information important? Why do we show this to you? It's because this information shows you that if the executive board is regularly informed about climate-related issues and actively takes them into account in strategy and planning, this shows stakeholders that the management level has taken a high level of responsibility. So it builds trust, and can also give you, in combination with, for example, key performance indicators, give you an impression of measuring those success against the targets. The second block on the right side is all about remuneration. So we see that 5 out of the 10 banks provide information on how climate-related considerations are taken into account in remuneration. We see that only 3 companies state a percentage of remuneration that is linked to climate-related targets. And the extent to which this remuneration component is linked to a specific greenhouse gas reduction target is reported by 4 of the 10 banks. Why is this block important from our point of view? It's important because it shows you that by having remuneration tied to those goals, it's not only making the executive boards more sensitive for this topic, but also giving them outside motivation to take action in this area. That's why this 3 aspects which come from ESRS in our methodology are so important and will be in reporting more frequently in the future. Last but not least, on the next slide, the financial effects. On the left side, you see only 18% of all possible points, which is a little. It's compared to the GEM all not surprising, because this is an area which is difficult or not very present in the reporting of all the companies we have analyzed this year. But on the right side, we see one number which is kind of promising. That's the number of companies reporting physical risks on asset, and that shows an awareness of direct climate risks. Remember, those physical risks are those ones, for example, that destroy houses and lead to maybe loan loss. I hope that was the right word, sorry. And therefore, this is a very important topic, and it's understood by the banks because it's already pretty good in there. However, the almost complete lack of reporting on financial aspects such as net revenue, transition risks, and market opportunities points to significant gaps, especially in the area of transition risks, of which 4 of the 10 banks report on. We need, as stakeholders, more information to get an idea on the resilience of the banks, how good they are prepared to what is there to come, and which you can read in different other reports, not only by the World Economic Forum, but also by the European Environment Program, which has published a report showing climate situation in Europe and connecting climate also to other topics such as biodiversity, water, and pollution. With this, I come to my outlook, and that's the ESRS readiness score, which you can find on the last slide. So our sample of 10 banks has an ESRS compliance score of 46% of all possible aspects which are required by ESRS. This is compared to the GEM All, which only reaches 41%. The best in class has a 67% compliance score, whereas the last in class only has a 20% compliance score. You see again that we have a very mixed composition on the right side, with 1 high performer, 5 in mid-range, and 4 below average performers. That brings me to my conclusion, which says that there is still a considerable need for banks to take action, especially in the area of climate reporting. The topic is highly relevant for them in several aspects. On the one hand, they are increasingly aligning their portfolios with the goals of the Paris Agreement, and they also need to report in more detail on physical and transition risks, as well as on direct or indirect risks, detailing out what is within their operational control and which is under their financial control, to give stakeholders a more complete picture of what they do in this area. And we think that the banks in the transition to a sustainability economy cannot be overestimated. So we will follow their reporting more closely also in the next year, and then showing you what has developed also in the light of ESRS in this sector. With that, I'm at the end of my presentation. Mike, do we have any questions?
So the audience is pretty silent, Ariane. I can only encourage you to, write in the questions, but maybe one question from my side is, in general, what kind of recommendations can you give to banks in order how to improve their reporting?
Mm-hmm. To fully understand climate-related risks, for example, it's really important to familiarize oneself with the reporting requirements and also understand why it's necessary to report on this. And there's additional information out there available for banks, especially for the ECB, European Central Bank, giving out not only the climate stress test for banks, but also giving out concrete information on what this means for bank. We also have from English term is missing, from the German government publication on how to include climate into advisory with clients asking for loans, especially those coming from the economic sphere. So there is a lot out there which can be taken into consideration.
I see there are no more questions coming up. Thank you, Ariane. I think it was a lot of content given here. If anybody has further questions, feel free to contact us, contact Ariane directly or me. We're happy to help you. And the presentation as well as the video will be uploaded shortly. So I wish you a wonderful rest of the day, everybody, and see you all soon.
See you soon. Bye-bye.